This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. And straight ahead on the program, inflation. I'm Tom Busby in New York.
I'm Caroline Hepker here in London, where we're looking ahead to Europe's insurers reporting earnings amid extreme weather.
I'm Brian Curtis in Hong Kong. We look forward to Alibaba's earnings and to see if the environment has really changed.
I'm Kaylee Lyons in Washington, where we're thinking about labor strife and its impact on President Biden.
That's all straight ahead on Bloomberg Daybreak Weekend on Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 106.1 Boston, Bloomberg 960 San Francisco, DAB Digital Radio London, Sirius XM 119, and around the world on BloombergRadio.com and via the Bloomberg Business app.
Good day to you. I'm Tom Busby, and we begin today's program with inflation as we await July inflation data coming out this Thursday. And joining us to talk about what to expect and so much more, Bloomberg's global economics and policy editor, Michael McKee. Michael, thanks for being here.
Great to be here again.
Well, for starters, what are we expecting to see in the July consumer prices report?
I hate to do this to you, but I'll start by being a little nerdy here. We are expecting inflation to rise because there was no inflation in July of last year. Inflation came in flat at 0% change in July of 2022. So if we get a little inflation, and we're predicting a little inflation, it just is going to make inflation overall go up. So we're expecting, at this point, a 0.2% gain for the month of July, which would push inflation up to 3.2% from 3%. Now, obviously, that is something the Fed is going to look through, and analysts are going to look through and not think it's a major issue.
Well, the Fed last month in June, 3%. That was very encouraging. Still, the Fed voted unanimously to hike its benchmark lending rate 25 basis points. That's after a slight pause in the previous meeting. What would it take in terms of CPI for the Fed to change up, to pause again, to, what would they look for?
Jay Powell was asked that question at his news conference after that Fed decision, and basically he said it would take several months of a trend. In other words, if we saw inflation rising for several months, then they would start to think that we have a problem, that inflation is coming back, and they'd need to crack down more. If inflation were to surprise to the downside this month and maybe another month, then the Fed might be inclined when they get to the September meeting to hold off again.
And the next day we get producer prices. What have we seen there?
There we've seen some disinflation. Producer prices have come down, particularly for energy and food and some of the more basic numbers. The issue is that we have seen oil prices rise in the last couple of weeks, and that could catch on. It wasn't through much of July, but that could catch on to the end of the survey, and we could end up seeing a little bit of a rise in headline producer prices. We'll be watching the core to see if progress continues to be made there. Producer prices and consumer prices are not directly linked because there are middlemen in the middle, but they give you a sort of a trend idea of which way you're going.
Now, you talked about energy prices, oil prices. Back to $80 a barrel. We haven't seen that in several months. Gasoline up 25 cents a gallon in just the past week. So there are legitimate factors in this, the heat, OPEC plus, but is there any end? Demand is actually down.
Yeah, the real problem has been, Tom, that we've had some refinery outages, especially down south, in part because of the heat, some unusual outages of refineries, and that's made gasoline more scarce, so the price has gone up. And there's a feeling that if and when things cool off down there, I feel lucky because we're in the Northeast where it's not been that hot. But if and when things cool off down there, then we should see the refineries come back online and prices drop. So sometime within the next month. Now, obviously, as OPEC Plus raises the price of the input to this oil, that's going to put some upward pressure on gasoline prices, but nothing to the extent that we have seen. And what would end up happening is gasoline prices would not rise by as much, and so you'd see a downtrend in headline.
And again, people are not filling up like they were before. People still working from home, don't need the gas, so it's confounding to see it keep going up even though demand has leveled off.
Well, it's been an unusual kind of situation, but what hasn't after this pandemic? Maybe people are flying more. Maybe people I don't know about taking the train, but taking cruise ships, things like that. We've seen good reports from the airlines. So maybe it isn't a driving summer for a lot of people. And I guess with the heat the way it is, you can understand that.
Well, people are traveling. Part of that, consumer confidence has moved higher. Fears about a recession. We just had last week Bank of America squash the previous forecast for a recession. But there are signs consumers may be pulling back on their spending. Let me give you a couple of examples that I saw, and that is Altria, the maker of Marlboro, saying cigarettes are so expensive they're buying discount smokes. Pepsi says people want Pepsi, but they're going to dollar stores, they're going to warehouse clubs trying to get a deal. So are we seeing that? Are there signs that consumers are being more conservative now?
We're kind of getting back to spending levels and spending patterns that we saw before the pandemic. A lot of people went to the Walmarts and the dollar stores and things like that, trying to save money in the past on groceries, et cetera, and they're going back to that behavior. But this is all kind of what you would expect in a world that's not overstimulated by the government and that is facing higher interest rates and costs of doing business because the Fed is trying to tamp down on demand. The issue becomes when it crosses some sort of line and we get to the point where people start to worry about recession and then pull back even more, and we get what results in a contraction.
And the clock is ticking on something that could really change that for 40 million Americans. That's the looming restart of those federal student loan payments. And that's in October. That's coming up pretty quickly.
That is coming quickly, and it's going to be interesting to see what happens because for a lot of people, they just use that money to spend on other things and in theory still have it. They just have to reprogram it to paying bills. But a lot of people took out other loans and used the money they were saving on their student loan bills to pay the other loans. And now they're going to have two sets of bills and one set of payments. And then there's another group that kept paying throughout the entire time period because they figured, well, it's going to come back anyway, and I should make progress on bringing down my loan, especially when they're not charging me interest. And so how that all plays out isn't going to be clear, but it isn't completely clear, but it is expected to have an impact. Now, economists sort of extrapolate from the total number of people with loans and their average loan payment and come up with a number like 1/10 or 2/10 off GDP. So not a huge amount, but enough to make a difference.
Well, a huge amount for people in their 20s and 30s, I would think. Well, let's talk a little bit more about the Fed and their timeline. The next meeting, September 20th, right?
Correct.
Well, what do we see between then and now that's going to influence the Fed's next decision as far as consumer spending, inflation, jobs, and more?
Well, we've got the couple of jobs reports, like the one we just saw, and we have another one coming up, which will give us the August payrolls at the beginning of September, and then the CPI report we're talking about, and another CPI report before they meet again, and we'll have one more PCE inflation report along with consumer spending at the end of August. So the Fed will have a couple of months worth of data before they meet again. And that goes back to the point I made about what Jay Powell said, that they want to see a couple of months trend to have an idea of where we're really going with this. Are we seeing inflation come down and demand soften? Are we seeing incipient signs of a recession because people are pulling back a lot? Or is inflation coming back? Those are the questions that they hope a lot of this data will answer.
And it's not just our central bank, but in England and in the Eurozone. They're dealing with very similar situations, but in a way, a worse inflation problem over there. Is it influencing the U.S. inflation, or is it the opposite? Are we helping them?
At this point, we are not helping Europe all that much because the dollar is strong, so their trade is not as vigorous with the U.S., but it does help the United States some. Now, trade in this case, because of we're in a post-pandemic situation, is less important between the United States and these other countries than it is among those countries. The European Union trades heavily among itself. And people there have done sort of the same thing that we have in terms of cutting back on goods spending. And companies have cut back on investments, and that's hurting the manufacturing powers like Germany and France and Italy there, because their economies are struggling with the lack of manufacturing, and we've seen that in the PMI numbers, and we see that in the industrial production numbers. In the UK, it's a combination of things. It's a little bit of that, but it's also the bureaucracy brought on by Brexit for trade has slowed trade and made it more expensive. They're still trying to negotiate new free trade agreements, and they haven't had a lot of luck, certainly not with the United States yet. So they have the added costs from that as well. And then they've got a very strong labor market in the same way that the United States does, which also puts upward pressure on prices.
Well, thank you, Michael. And that was Bloomberg's global economics and policy editor, Michael McKee. And coming up on Bloomberg Daybreak Weekend, insurance companies attempt to change with climate change risk lurking. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Up later in our program, earnings from Chinese e-commerce giant Alibaba and the Chinese government's role in tech in that country. But first, extreme weather gripping many parts of the world, with July likely to be announced as the world's hottest month on record. The impact on society is enormous, and on the insurers who navigate climate change. For more, let's head to London and bring in Bloomberg Daybreak Europe anchor Caroline Hepker.
Tom, Europe's big insurers from Allianz to Generali, Munich Re and Zurich Insurance are reporting their earnings in the days ahead. But Europeans are among the least insured against certain types of extreme weather and other natural disasters, something that we've seen a lot of across the continent over the last few months. For more, I'm joined by Bloomberg's Germany correspondent, Oliver Crook. Oliver, great to have you with us. Extreme weather has hit Europe in the past few months in a way, I think, I'm sure you'll agree, that has made many people think about climate change in a totally new light, don't you think?
I would think so. But, obviously, as you know, this is an exceedingly polarized issue for some people. It's hard, though, when you see the kind of trend in terms of the temperatures rising over the last century to kind of not at least pose yourself the question, particularly when you see the ways that it touches, human life in all this different way. We've talked about how it touches agriculture. Sometimes it's cooking food right on the branch. You have, all these rivers drying up. The Rhine is one we've talked about a lot, the most important waterway in Europe, that moves just tons and tons and tons down, up and down every single day. And that basically becomes unnavigable at a certain point. We've seen it in France with the nuclear reactors. They can't draw enough water to cool off. And obviously these wildfires in Greece. So I think it's front of mind for everybody. I think the challenge that the market has is, how do you price these risks? And how do you think about these financially?
Yeah, absolutely. And you were speaking to someone very interesting, Munich Re's Ernst Rauch, about this, because they've got a whole climate centre and they do big reporting, not just on their own business, but kind of more broadly across the insurance sector. They've also, Munich Re itself has its earnings coming up in the days ahead. Is weather making certain things uninsurable?
So this is the question. I asked him if it made things uninsurable. And so he gave a sort of interesting response to that. He said, listen, we're an insurance company. We will insure anything. The problem is you will not be able to afford it. And they look at a sort of simple equation about kind of the risk that is generated by kind of natural disasters, how vulnerable, how, in what ways have you mitigated it, and the underlying value of the assets. And he says that even despite the latter two, what he's seeing across the globe is a higher risk of basically weather-related events. He says 80 to 90% is down to weather, and that a third of all of the losses in the first half of this year were not down to actually a single weather event, but just more powerful storms over in the United States.
Yeah, absolutely. And the data that Munich Re pulled together showing a near record year for losses due to natural disasters. So things like earthquakes in Turkey and Syria and the storms that you mentioned in the US. I mean, the numbers globally are quite staggering, aren't they?
Yeah, absolutely. I mean, $110 billion in the first half of the year. And really, again, I was very interested to speak to him because in a topic that is polarized for many people, it's their business to understand what is going on in the world and to try to appraise that risk. So I asked him about kind of how he really thinks about climate change and how much of these losses can we say are really attributable to climate change.
We observe upward trends of losses from weather-related events in many parts of the world and with many weather-related perils. Depending on the region, it is flooding. It can be what's called these convective storms or severe thunderstorms in the United States or wildfires in some parts of the world. So with this upward trend, we, of course, as a risk management company, we need to understand what are the drivers of this trend. And the first element of these drivers are socioeconomic factors. So increasing wealth and population. And inflation, of course, today plays a major role in this as well. However, even after adjusting for inflation and wealth, we do see in some regions upward trends with respect to losses, which cannot be explained by these socioeconomic factors. And here we analyzed and also meteorological data. We collaborate with scientific organizations in order to understand whether there is a link between increasingly severe weather, be it thunderstorms or flooding, extreme rainfalls and others, and the losses we observe. And the outcome is, as of today, is that we have strong indications, not a scientific proof, but strong indications that part of the increase of losses is already driven by changing weather patterns, and they are by themselves driven by climate change.
And sort of regardless of the cause, if this is just proportionally and numerically going up, this obviously is going to bear on the price of insuring things. Can you talk to me about how much more expensive insurance is going to get as a result of these changes?
Well, first of all, if the hazard component of our analysis, so the probability of severe flooding or severe other weather-related events is increasing and or the intensity of these events, then yes, the overall risk increases and that drives the premium. Now, the question is, of course, by how much? And there is no simple answer, and especially no uniform answer for all parts of the world and all perils.
I also want to talk to you about the risk, not just of insurance prices going up, but basically parts of the world becoming uninsurable. We hear about this in Florida, California, possibly a risk. Now we see kind of weather patterns changing and how hot it's getting across Europe. What's the risk for the uninsurable portions of the world where you just cannot make an assessment or it's just too risky?
The challenge is much more if we look at the need to adjust our prices in line with increasing risks. And here climate change drives up the risks and as a consequence drives up the risk premium.
So that was Ernst Rauch, the head of Corporate Climate Centre at Munich Re, speaking to you. Oliver, as we think then about, the financial consequences of this, how do we think about then the earnings that we're going to get from Munich Re, Zurich Insurance, Generali, and the other big insurance names across Europe?
Yeah, so listen, I'll talk about Allianz because they're sort of the biggest and they were released over on Thursday. And so they've actually have had a pretty good run. And what's interesting is because Allianz also has this massive asset management unit, but actually this year, it's the insurance that's done the heavy lifting. Their insurance side of the business has done very well, and they may even raise, operating profit outlook. And so things are looking very solid in the insurance sector. They've actually, I don't know how big natural catastrophe will be in terms of their bottom line. We may see some more claims in Italy and Germany in the second quarter due to the floods, but they did not have huge natural catastrophe expenses over in the first quarter. And that is in part, perhaps, Caroline, something that I'm sure we'll talk about, is the lack of insurance for natural disasters here in Europe. I was actually astounded by some of these numbers.
Yeah, absolutely. This idea of the underinsured in Europe is a big issue, especially, as you say, you've highlighted, the wildfires in Greece, but there have been drought conditions in Spain as well as along the River Rhine.
Yeah, absolutely. And when you look at a sort of global breakdown of kind of what is uninsured, Asia Pacific, 57% of the direct losses are uninsured. North America, that's only 24%. Globally, on average, it's 61%. In Europe, it's almost 90%. So, I mean, that to me came as a real shock. You think of a kind of more developed nations and richer nations are kind of more risk averse and more willing to insure certain assets. And I was really stunned to discover that that's the sort of European figure here.
Yeah, absolutely. Oliver, thank you so much for joining me. We look ahead then and await the earnings in the next few days from the big insurance names here in Europe: Allianz, Generali, Munich Re, Zurich Insurance and others. So there'll be a lot of focus on those results. Thank you so much for being with me. I'm Caroline Hepke here in London. You can catch us every weekday morning for Bloomberg Daybreak Europe beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. John.
Thank you, Caroline. And coming up on Bloomberg Daybreak Weekend, Alibaba earnings and the Chinese tech industry. I'm Tom Busby. This is Bloomberg. I'm Tom Busby in New York with your global look ahead at the top stories for investors in the coming week. What's next for tech companies in China following the end of a government crackdown? Chinese e-commerce giant Alibaba among those in focus with an earnings report on tap. And for more, let's go to Hong Kong and Bloomberg Daybreak Asia host Brian Curtis.
Tom, Alibaba reports earnings in the coming week, and the results will be arriving at a time that the landscape is changing fast, especially for big platform companies in China. Alibaba, Meituan, and peers may get an extra subsidy through 2024 to speed up their business expansion. That's a step that policymakers hope will speed up consumption in the country. China's been making a number of efforts of late to stimulate the economy, and consumption is a very big part of that story. Joining us now is Sarah Zheng, Bloomberg China technology reporter. So, Sarah, let's talk about the earnings first, and then we'll take a look at the broader environment and see how that is changing. What are we expecting in terms of sales and profits from these earnings?
In this latest quarter, we're expecting to see some of the recovery that you just talked about being reflected. Obviously, consumption has been more uneven than expected following China's reopening, but there have been new revenue growth factors that have been, injecting momentum in the various businesses. And that's because Alibaba announced its historic reshuffling with a division into 6 individual business units earlier this year. And so that's given each of the units a chance to potentially seek independent funding or public listings. So that, in addition to some of the latest leadership announcements and reshufflings that we've seen, are expected to bring more optimism for investors.
We understand that the consumption boom is lagging a little bit compared to what was expected. Is that the case at that end, at the sort of e-commerce segment that Alibaba represents, or is it right across the board?
Yeah, we're expecting that to be reflected in terms of year-on-year growth, especially for the bread and butter business, Taobao and Tmall, and also in the international business. There's going to be some headwinds from just the broader macroeconomic environment for AliExpress, Lazada, and Trendyol, which is their businesses in Europe and Southeast Asia.
What about the cloud business? Is that something that will stand out in terms of the rest of the earnings?
So cloud is very interesting because we saw that the CEO, Daniel Zhang, he's stepping down and he's going to focus just on heading up cloud. Cloud was expected to be a pillar of growth for Alibaba in the years to come. It's been, loss-making so far, and it's been losing a bit of market share to some of the government state-backed cloud providers. But because of the energy and the frenzy and excitement around AI in China's market right now, that is something that we're looking to see Ali Cloud, now that it's separate and has its own operating environment where Daniel Zhang can focus entirely on cloud, to give it some new energy.
So at the top now with Zhou Cai there, it seems like it's coincided with his being named to that position and Daniel Zhang being moved to the cloud exclusively, that the stock has kind of caught fire. I'm not sure the two are connected, but if you could say a couple of words about what it means to have Zhou Cai back in that position.
Sure. So Zhou Cai, he's a known entity. He's been with Alibaba since the very beginning. Having him there as a reliable, person at the helm of the company, that's something that investors are excited about. Same with the new CEO, Eddie Wu. He's also been a long-time veteran of the company. So these are people who have been with Jack Ma, who's sort of still the spiritual leader of the company from the very beginning. Again, known entities, known quantities who have been heading up some of the major units since the beginning. Eddie Eddie Wu, for example, he was the chief architect of some of Alibaba's flagship products like Taobao and Tmall. So we know that.
So it's a positive.
It's a positive. That's right.
You mentioned Jack Ma is still the spiritual leader of Alibaba, and I'm just curious about to what extent he's still involved in the running of the company.
It's interesting because earlier this year when he reappeared on campus, employees were so excited to see him. And that sort of speaks to the mantra and maxims that he has instilled in the company's culture from the beginning. Joe Tsai and Eddie Wu, like I mentioned, they both embody that as well. He is not directly involved in the day-to-day operations from what we know anymore, given, the regulatory scrutiny and the tech crackdown over the last 2 years. He's really been stepping back from the limelight. And there was a lot of speculation before about whether or not he could return to China. We did see him back in Hangzhou. So that's another positive sign from the regulatory side.
Now, I'm curious about the overall environment. We've had a little bit of a change in thinking in China, I think, from policymakers, even to the extent that in the property market, what they've been saying now is they've sort of not repeated the old mantra that houses are for living in, not for investing in. I wonder if the attitude has changed for the big technology companies, the big platform companies. It seems like ever since the Ant IPO was pulled, that big was bad and they wanted to support smaller companies. And I wonder whether or not that has changed.
Right, exactly. It's really interesting. We're seeing more and more signs from regulators that they want the big tech companies, Tencent, Alibaba, Baidu, and the rest, to help them resuscitate what's really a flagging economy at the moment.
So big is okay now.
We won't see them return to sort of the swaggering days of before COVID zero and before the tech crackdown in 2021, 2020. But we will see them slightly be unshackled to be able to pursue sort of tech sectors that Beijing sees as its primary priorities strategically. So for example, in AI, cloud, computing, chips, these are all strategic areas they need to compete with the US. And we're going to see them be able to move forward in those areas.
In the past, they snapped up a lot of smaller companies, startups, and really used the energy there and the push in new technology areas. Is that likely to continue?
That, it seems like, is still being reined in to some extent. So we're not going to see them be the main drivers of venture capital investment. So a lot of the startups we're talking to now, they're not really looking for investments from Tencent and some of the big giants anymore. Now they're more focused on just like smaller level applications and working with maybe early stage kind of investors rather than trying to be acquired by the big giants.
And I wonder whether or not they're as successful as they were before in attracting talent.
Talent is a big problem. Like, we've been sort of dancing around this issue of China's sluggish economy. And so youth unemployment, that's a really big issue. Another reason why Beijing wants these big tech companies to come back and revive some of that that employment situation. But yeah, talent is definitely a big issue. We were seeing some layoffs from some of these companies and just a lot of anecdotes about people leaving the industry or not being able to get the same kind of bonuses that they did before.
Now, we had an interesting moment recently where Ant wanted to buy back shares and wanted to buy back shares from all the shareholders, including the biggest one, Alibaba. And Alibaba chose not to sell. Now, some people interpreted that as a positive because it meant that Alibaba wanted to retain, more ownership and involvement in Ant. And others might have wondered whether or not that meant that there was a little bit of difference in the management teams. Have we been able to explore that?
We have. So I think what Alibaba said officially is that they decided not to sell any of their stake because Ant is still an important strategic partner to them. And what analysts say is that actually they're really hoping that, as Ant starts to come back, they're able to build up their business again. They can help contribute to, for example, Alibaba Cloud, Ali Cloud's growth going forward. They have been a really big contributor to their revenue. And now that they can build themselves back up again and expand, they can again be one of the highest contributors to that cloud revenue.
So we've seen Alibaba split into 6 different parts, and that's kind of slow in rolling out. For the other big companies like Tencent and Meituan and perhaps a few others, is it likely they'll take that path as well?
Alibaba actually is relatively unique in this aspect where when we talk to analysts, they say that splitting into 6 different units allows them to unlock different kinds of business potential of these individual units. So, for example, like Ali Cloud, Cainiao, which is a logistics arm, and international digital commerce. So, for example, AliExpress, Lazada, they all have business models that can be spun off relatively independently, where it's different from a company like Tencent, which is built around WeChat, this everything app that everyone uses in China. It's a lot harder to break off parts of the Tencent business from that core ecosystem. So we're not expecting to see the same kinds of movements from, competitors like Tencent.
Sarah Jung, Bloomberg China technology reporter. I'm Brian Curtis, along with Doug Krisner. You can catch us every weekday here for Bloomberg Daybreak Asia, beginning at 6 a.m. in Hong Kong and 6 p.m. on Wall Street. Tom?
Thank you, Brian. And coming up here on Bloomberg Daybreak Weekend, we go to Washington and a look at all the union activity lately and what this means for the presidential race. I'm Tom Busby. This is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Labor and politics in focus as we head to the 2024 presidential election. For more, let's head to our Bloomberg 99.1 newsroom in Washington and Bloomberg Sound On co-host Kaylee Lines.
Tom, that's right. Labor has been a hot button issue this summer. So joining me now to talk more about labor is Ian Colgren, who reports on the subject for us here at Bloomberg. So Ian, first of all, let's just talk about UPS. This deal with the Teamsters is just a handshake deal at this point, right? Is there any chance that it's not going to be ratified?
There's always a chance that a deal won't be ratified and that everybody is going to be surprised. At this point, it's looking, however, like the deal probably will get through. There was a near unanimous vote of the local chapters of the Teamsters that endorsed it. However, that doesn't mean there's not grassroots opposition to this deal. And in fact, there is. Just yesterday, I talked to one of the leaders of one of the Vote No campaigns, who is just starting to ramp up the campaign and holding webinars and getting the word out on Twitter and Instagram, other social media. So we'll see if some of this opposition metastasizes in the next couple of weeks as Teamsters vote. But at this point, it's looking fairly safe to say there won't be a strike.
So maybe we won't see a strike in that case, but what's the likelihood we will see more strikes this summer or later on this year? I'm thinking of the auto workers primarily here.
Strikes, as we've seen over the past few months, are events that tend to build on one another. You see all of the action going on in Hollywood right now. There is certainly a possibility that the auto workers could strike when their contract expires in September. It's something that they have not been shy to do in the past. In 2019, they went on a 6-week strike, which was the longest strike ever for the auto workers, longest auto strike in the history of the United States. And now they have a fiery new leader who has promised to really take the companies to task. And that will be a whole different dynamic here as we get closer to the drop dead date for negotiations.
Well, speaking of leaders, Ian, how does all this play for President Biden, who has tried very hard to bill himself as a pro-labor president?
All of these strikes put President Biden in a tough spot because it essentially forces him to choose between the union and the company. And that's not a choice that he wants to make under any circumstance. He's somebody who has also tried very hard to champion manufacturing and American innovation under his administration. And it's just sort of a no-win situation for the president if he has to intervene in some of these strikes, because he's going to have to make somebody really unhappy. And in the case of the rail deal late last year, he did have to make a lot of union members really unhappy by forcing a deal through Congress to avoid a potentially crippling strike for the U.S. supply chain.
So how do you think this will play in the 2024 race, considering he's not just a sitting president, he's seeking re-election?
He certainly risks alienating his base if he angers too many union members by siding against them in some of these negotiations. They're going to be watching closely to see whether his actions and his words match. It's something that no president really wants to deal with during a re-election campaign. It's a show of populist anger from the base that has very little chance of benefiting a moderate incumbent like President Biden.
Well, looking forward to your continued coverage of the labor strife. Ian Colgren, who reports on labor for Bloomberg, thank you so much. And Tom, back to you.
Thank you, Kaylee. That was Bloomberg Sound On co-host Kaylee Lyons reporting from our Bloomberg 99.1 newsroom in Washington. And you can hear Sound On weekdays 1 to 3 p.m. on Bloomberg Radio. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.